Financial analysis, fundamental analysis, and technical analysis. How are they linked together? Let's find it out in this video. So financial analysis is the broadest expression of the three, and it refers to a process of evaluating a business, an investment, a project, or any finance-related transaction, operation, or activity. So we can say the fundamental analysis and technical analysis are the two typologies of financial analysis, especially when we talk about evaluating a business, a company, an organization. This is because fundamental analysis focuses on information available in the financial statements, which are useful to determine the economic and financial value of that company, and compare this value to the related share or stock's value. On the other side, technical analysis, which we will see shortly, focuses entirely on the movements and trends of the stock's price, as well as the public sentiment about its performance. Therefore, the key aspects of fundamental analysis are the analysis of the financial statements, in which we find historical data and the managing director's future outlooks if there is any company report attached. The valuation of the asset, which is in this case the same company or organization on its whole, and in addition to quantitative information, the assessment of the quality of the business. When it comes to financial statement analysis, we take into account pieces of information given by the income statement, which reports revenues, costs, and other expenses, and therefore the profit or loss of the activity. The balance sheet, which represents the patrimonial condition of the company. The return and profitability analysis, which is possible with the application of both the income statement and balance sheets data. And the cash flow statement, that tells us how and for what operations cash has been managed. With the income statement, it's possible to make a vertical analysis, going from the top item, which is revenue or sales, down to the net profit or loss. And we can see how much of the revenue is spent for each type of expense and how much remains in margins in percentage terms. With the horizontal analysis, we can examine the trend of each item of the income statement throughout the years, so that we can make a time comparison of margin and results. If the income statement shows a flow of economic items that renew each year, the balance sheet is a snapshot of what a company owns and owes to other parties. The company can own assets like cash, receivables, which are money to be collected from customers for some good or service that's already been sold, and equipment or other long-term resources. At the same time, the company owes the equivalent total amount of assets to those who finance the business, such as banks or other lenders, and their shareholders, investors, or partners. Given the distribution of every asset, liability, and shareholders' equity in the balance sheet in a certain moment, we can check the financial situation of the company by calculating liquidity ratios like the current ratio, which is useful to see how much of current assets like cash, receivables, and inventory can cover current liabilities like short-term debt, and leverage ratios like debt on equity to see the proportion of how much is financed by others and how much is financed by the owners. By taking some items from both the income statement and the balance sheet, we can check some return ratios like return on equity, that is given by net profit divided by the amount of equity, and efficiency ratios like the asset turnover, that is calculated as sales divided by the average total assets on the balance sheet in 1 year, so that it's possible to see how much those assets can contribute to generating revenue. Some profitability ratios can be calculated by taking items from the income statement only, like net profit ratio. This shows how much of the amount of sales remains as net profit to the firm after deducting all the related expenses. The cash flow statement offers a look at how cash is managed and for which activities is employed. The statement shows the cash flow of the daily business operations, such as payments received by clients, payments made to suppliers, inventory purchases, etc. The cash flow of the investing activities, such as the purchase of long-term assets like equipment or machines, and the cash received from possible sales of fixed assets. The cash flow from financing activities, such as cash inflows for new loans and cash outflows for debt repayments. Finally, fundamental analysis is made to evaluate the asset, which is the same company we've analyzed by taking information from the financial statements and other reports. The valuation is made to compare the data that we've gathered with the market or fair price of the same company, which is the price of a company's share or stock. And this is useful to understand if the company seen as one asset is overvalued or undervalued. Generally, in the business, the valuation is necessary if the company has to be purchased purchased or sold, in case of strategy planning for future business development or diversification, in case of new financing from bank, crowdfunding, or other resources, or when an investor wants to understand more about the current situation of the company, its possible evolution and future returns. Three are the main approaches of evaluating a business. The cost approach, which focuses on historical costs incurred to build and develop it, and possible replacement costs. The income approach, which consists in forecasting future cash flows. And the market approach, through which the business is compared to similar public companies or the value of precedent M&A transactions where similar firms were involved. It's usually necessary to look not only at numbers but also the quality of the business. For example, taking in consideration the business model, the industry in which it operates, the competition, the management skills, and the corporate governance. In short, the other type of financial analysis that can accompany the fundamental analysis is the technical analysis, which focuses more on the price of the company's stock. This discipline is applied in the trading sector, where investors and analysts pay full attention to the movement of the stock's price, the volumes of the total quantity of shares or contracts traded for that security, the chart patterns that help to see how prices move in certain directions, and the oscillators, which are tools used to mark high and low bands between the extreme values, with a trend indicator among them. Tools like these are helpful to understand if the stock is overbought or oversold, for example. With all that being said, we are sure that both fundamental and technical analysis can come in handy when examining a business, a stock, and more generally an asset and its evolution. If you like this video, make sure to subscribe and follow us on our channels so that you can always be updated with new knowledge builds. Bye!